Thank you, Bill, for that kind introduction. I appreciate it. I enjoyed working with you when you were at the Federal Home Loan Bank of Seattle, which was obviously a challenge for you and for the agency, as we remember. And thanks to the University of Maryland and NYU for sponsoring this event today on what I think is an extremely important topic. When we put Fannie and Freddie into conservatorship in September of '08, we expected the Congress to tackle this problem in '09 and come up with a solution. Well, it didn't happen. It didn't happen in 2010, so here we are now in 2011. And hope springs eternal. I'm hoping this year there actually will be some movement because the status quo in my mind of the U.S. government dominating the mortgage market is not the right long-term solution. It is nice to be back in Washington. Don't get here that often anymore, but it's even nicer to be able to say it's nice to be back in Washington and not having to work in Washington. I've been out of D.C. now for almost a year and a half, but I've continued to be pretty active in the mortgage market in that we're investors in 4 banks. We have one of the big mortgage servicing companies. We're also an investor in the only financial guarantee company that's still running business, and also through our mortgage fund and private label securities and whole loans. So hopefully I can bring not only the Washington experience, but some of the, may I use the word, real world experience that you get outside the Beltway. Let me just start it before I get into Fannie and Freddie. Obviously they're giant at $5.5 trillion. You know, at one point I used to have a chart that their outstandings were pretty close to the outstandings of the U.S. government. Obviously that's changed pretty dramatically over the last 3 or 4 years, but they're still big in comparison to virtually anything else. But I'd like to start really by just looking at you know, the context we're looking at as we're looking at the future of Fannie and Freddie. And I think obviously we all know this, that and this is federal outlays as a percent of GDP. We're at now almost 26%. Much of this was needed to stimulate the economy, but as you can see, we're at a new post-war high. And that does, you know, sort of, I think, should inform what we're thinking about in the future of Fannie and Freddie. And as bad as it is now, this chart's a little complicated, but this is CBO's projections of the federal debt as a percent of GDP going forward. We're, you know, in the 60s now, but in about 20 years we'll be starting to hit really dangerous territories of the 80s, and then we'll get up to over 100 if we don't do something. So, you know, that would again tell me that we cannot continue to put all the burden on the U.S. government going forward, and we need to think of other approaches. You know, if we don't do anything, we will be in Greece in 50 years. I just have to do a little commercial for one of my other jobs that I had in various Bush administrations. And I spent several years pushing the message that Social Security is a program that needs to be reformed. And the overall entitlements program needs to be reformed, obviously, Medicare, Medicaid, and Social Security. But this chart, just to remind everybody, and it's quite different actually than when I was there, because we didn't think there was going to be a dip, which we are having now when Social Security is not paying for itself, but it's supposed to recover. But then we're going to see in well less than 30 years, 20-some years, a fall off the cliff. People's benefits are going to be cut dramatically, and that's even the baby boomers, and certainly the baby boomers' children will see their benefits cut dramatically if we don't figure out how to fix that. And frankly, that's a much easier program to fix than Medicare. But now let me turn to another important sector of the economy, and that's the banking sector. Obviously, they have had a tremendous problem during this period and about 325 banks have been closed. We have about 7,800 banks. That's cost the FDIC, I think, somewhere around $60 billion. And still, about 12% of the banks in the U.S. are classified as problem institutions. That's over 860 banks with almost $400 billion in assets. Again, another issue that must be tackled. One of the things that may be surprising to this audience is that it's really not residential that's caused most of the problems in the housing market. It's really, as we looked at banks, and we probably looked at 100 banks, it's really the commercial real estate and in particular land development, as you look at all these community banks that made some pretty drastic investment decisions. But obviously mortgages are still an important part of a bank's balance sheet. And as you look at this, first the left-hand side, the single-family world is obviously much bigger, almost $11 trillion. And again, the agencies dominate that marketplace, with the banks having about 25%, and that, of course, includes seconds and HELOCs and home equity loans and as such. And then the asset-backed securities, MBS, about 13%. The multifamily world is much smaller, but still an extremely important segment, and probably one that's going to be growing, as we heard in the previous panel. Again, the agencies are dominant, but not as dominant, and with banks taking a big portion as well. And as we look at the future of Fannie and Freddie, I think it is important to think about multifamily as well as single family. The whole dialogue seems to be on the topic of single family, but I think we also need to consider the multifamily world. This chart's a little old, but as you know, the mortgage world is really dominated by Fannie, Freddie, and FHA at this point. The green blocks there are the private market, when that was largely private label securities, and as you can see, they pretty much disappeared. And the big dark blue on the bottom is Fannie and Freddie with FHA in there as well. I mean, as you can see, by market share, they're almost at 100%. The combined Fannie and Freddie, the top line, and FHA, they're now running around 90% of the mortgage market. So again, we're totally dominated by the government. I don't have the multifamily chart, but it's not that dissimilar at this point either, where the multifamily world is totally dominated by Fannie, Freddie, and FHA. As Bill mentioned, we also at the agency oversaw the federal home loan banks, and they may or may not get into this dialogue, but I thought I'd at least show one slide that I think is rather amazing to me, and that is that the federal home loan banks actually, their GSE, actually did their job through this cycle. Their job is to provide liquidity to the banks that are providing mortgages around the country. And as you can see, at year-end 06, before the crisis, they had about 640 billion in advances to banks. At the height of the crisis, they peaked at over $1 trillion in advances. And now, as liquidity has come back into the banking sector, it's come down pretty dramatically. That's not to say that the federal home loan banks don't have some problems, and obviously they, like Fannie and Freddie and many others, got too heavily involved in the private label mortgage-backed security market, and in particular what once were AAAs and are no longer AAAs. But you know, the future of the federal home loan bank system, I think they did prove themselves. They were a creature of the Depression, and they have proven themselves throughout this period. But there's still some areas for debate in that structure that I think should be looked at, including trying to put some sort of fund together to back them up in a crisis. Now, just turning to the mortgage market, you all know these statistics, but I think it's, again, worthwhile looking at it. You know, we're starting to see somewhat of a turn in serious delinquencies after hitting what really were extraordinary highs. Serious delinquencies are 90 days or more. And as you can see, the top two lines are subprimes. The adjustable rate one went through the ceiling and still over 40%. And overall subprime are about almost 30%. The amazing thing to me is all loans are almost 9% serious delinquencies, and even prime loans are 6.4% serious delinquent over 90 days overdue. You can see there's two other marks below the 6.4, and those are Fannie and Freddie serious delinquencies. And it's the CEOs of Fannie and Freddie always like me to put this chart up because it shows that they are less than the prime market. And they did have some discipline, but they also, like everybody else, got too heavily into Alt-A in particular and subprime, and as the mortgage market bubble increased and they were losing market share pretty dramatically. Their response was to loosen their credit standards and also, especially in the case of Freddie, buy private labels mortgage-backed securities. And obviously that has come home to roost in a big way. And if you're allowed to have only 1% capital, even those 3, 4, 5% serious default rates are going to eat into the capital. It was mentioned in the Q&A session, the underwater mortgage problem out there, and I think it's an ongoing and very serious problem, and it's one of the reasons we feel we're not out of the woods. Almost 25% of the mortgages in this country are underwater, and almost 10% are 25% or more. So that's 5 or 6 million mortgages that are 25% or more underwater, and you have to believe that there's going to be a lot of foreclosures coming out of that, and strategic defaults, which are continuing to grow. It is a phenomenon that is in somewhat concentrated, as you can see there, with Nevada over almost 2/3 and Arizona almost a half, but it is also spread out over communities throughout the country. One thing that was mentioned in the last panel, and I think it is really worth remembering, because sometimes we get a little parochial in the U.S. and only think about the U.S. mortgage market, and we forget that there was bubbles throughout the world, and actually there was bubbles throughout the world in many asset categories besides housing. A risk was mispriced dramatically across many sectors, but especially in housing. This chart is just 3 countries. The top one is Ireland in green, needless to say. And as you can see, that they had a tremendous bubble there. They didn't have a Fannie and Freddie. They didn't have a 30-year mortgage. It was floating rate mortgages, but they had a tremendous bubble that they're only starting to recover from. Most forecasts say it's going to be 50% off the top there. We're actually looking at investing in an Irish bank at the moment, so we're spending a little time with that marketplace. We also invest in a UK bank, and you can see their bubble was somewhat bigger than ours, but it hasn't come off as much. And then our bubble using the S&P index is about 30%. And our view is that it could be another 5 to 10%, so we're going to see a lot more underwater mortgages. Well, I guess it's time to turn to Fannie and Freddie. And I guess probably it's worthwhile, if you're going to think about the futures, to think what went wrong at Fannie and Freddie, besides everything. And first of all, there was, as we were just showing you in the previous chart, a housing bubble. And it was fed by private label mortgage-backed securities, certainly the GSEs, investors having a lot of cash trying to get that extra yield, mortgage originators that basically didn't do their job of proper underwriting, the borrowers that lied or at least weren't paying attention to the mortgages they were getting. Certainly the rating agencies have a lot to answer for in their ratings of those private label securities, but also Fannie and Freddie. There was, from us regulators, a slow response. So that all fed the housing bubble. As I've said, the capital requirements for Fannie and Freddie were much too low, 45 basis points for a mortgage-backed security, which we had an extra 30% on, but the extra 30% on 45 basis points doesn't really help too much. And certainly their blended capital could be less than 1%. The affordable housing goals were pushed up too high over both the Clinton and the Bush administration. And they got to the point where it was very hard for the Fannie and Freddie to make those goals, and in some cases they did lower their standards to do it. The OFEO's regulatory powers were too weak, and they were purposely too weak. Fannie and Freddie were around when OFEO was created, and they made sure that they were too weak. One of the key things to me is there was really no debt market discipline because of the implicit guarantee, because the rating agencies basically felt that they were too big to fail, and I guess they were right. But there was a lot of pressure from the equity investors to get that stock price up to grow their portfolios, which we did cap. But I mean, there was only one side pressure from the equity markets, but nothing from the debt markets, which at least other financial institutions have some pressure coming from the debt markets. And they did have those massive portfolios, which we were able to cap. And they did increase, everybody was worrying about the interest rate risk in those portfolios, including the management. And I think in a way, they were spending so much time on the interest rate risk that they didn't pay enough attention to the credit risk in those portfolios. And lastly, and importantly, as you think about replacing or fixing Fannie and Freddie, is they had much too much political power. And that really helped delay the reform legislation and in a way helped cause the problem. If we had had legislation 3 years before, the bubble might not have been as big. I think the key question as you look at the future of Fannie and Freddie and GSE reform is, what do we want the secondary mortgage market to look like in this country? I mean, some countries don't really have much of a secondary mortgage market, so do we want a secondary mortgage market? And I think, I think we need a secondary mortgage market. That they provide for banks the ability to move mortgages off their balance sheets, which helps reduce the risk and helps to better match their loan to deposit ratios and to support what is a giant market, $11 trillion. One of the things we were talking about, the European banking sector before, they don't have a Fannie and Freddie, they have covered bonds, and they do some securitization. But you'll see that banks' balance sheets in Europe, a lot of them have much more hot money, wholesale money than US banks. So actually one of the advantages of Freddie and Fannie over the years has been to help the banks balance their balance sheets. And so that's something to keep in mind going forward. Obviously, any secondary mortgage market must ensure that the providers of the mortgages give the consumers protection, choice, and transparency. And there's a whole series of considerations that have been talked over the years as you look at reforms. And these are some of the things to keep in mind going forward. Certainly, how to get the private label mortgage market back, again, is important in my mind. And what you do in the government sector and the government guaranteed mortgage-backed sector has an important role in that. Certainly, the future of the 30-year mortgage has to be an issue. Yes, there are some countries around the world that have 30-year mortgages, but they're very small in comparison to the market share that our 30-year mortgage has. And it does present, if it's fully prepayable like it is in the U.S., tremendous interest rate risk as well. The TBA market has been mentioned. It's very useful for hedging and locking in mortgage rates. Affordable housing is an important issue, and in particular, again, I think multifamily housing and how you support that in this country. There will be a shortfall in multifamily housing in the next few years because there hasn't been a lot of building, and we're going to start to see those people that are in with their parents come out of those houses. We also may see people, the baby boomers, starting to retire and sell their houses and maybe decide to rent going forward. So there'll be a variety of reasons why we might see multifamily increasing. Mortgage insurers, Fannie and Freddie had this side industry that effectively fed off them, if you will, which was the mortgage insurers, because they could only do an 80% loan-to-value mortgage. That industry became very concentrated. It's regulated by a series of state insurance commissioners that maybe didn't understand it very well, and it's caused some significant problems as well. Another thing, especially after the crisis, is we have a real concentration of originators in this country, with the top 4 or 5 representing well over 50%. And that's not only on the originators, but to Bill's point, it's also on the servicers as well. We have this tremendous concentration. And is that healthy or not is something to be considered. The role of the mortgage servicer, as Bill said, is something that has to be re-looked at. The compensation scheme doesn't make a lot of sense. I would argue that a servicer having reps and warranties for a mortgage that didn't originate doesn't make a lot of sense, that the mortgage is going to be put back to them. And then with the new legislation, the qualified residential mortgage and skin in the game is another issue going forward. So as we look at the future, those are some of the things that we need to think about. And certainly as we look at the possibility of restarting the private label mortgage-backed market, there's a whole series of issues. And I don't have it up there, but I think it's sort of what slowed down reform in this market and everything is the fragility of our mortgage market still. As we saw, there were 25% or 23% of the mortgages are underwater. We're still at very, very high default rates, and we're not through the woods. And there's no confidence in the market until we get some confidence back and people buying. We're going to be in a fragile state. And certainly the robo signing and all the other things going on in mortgage servicing hasn't helped, and the 50-state investigation of the mortgage servicers. So there's so many other things going on at the moment. It's making it very difficult to really come up with a long-term plan. And Dodd-Frank itself, it's 2,300 pages. Hundreds of regulations will come out of it. No one knows exactly what's going to happen. That's a big uncertainty. Obviously, Fannie and Freddie's future is a big uncertainty. How you implement skin in the game is an uncertainty. There's certainly a big stigma, and rightfully so, against the private label mortgage-backed security market, given how poorly it performed. And we need to, again, get the market stable, and we also need to promote and look at better transparency in the mortgage market space. Thought I'd lay out some principles for the future of the enterprises, assuming they have a future. And one can debate, and I will talk about my proposal at the end here. But I think if you look again at what went wrong, there needs to be some principles established. And first one is you need a well-defined and consistent mission. And if it's going to have affordable housing, you have to do it in a safe fashion. And you have to do it in a way that it doesn't push them to lower their underwriting standards. There has to be a very clear demarcation between the private and public sector. Obviously, in the past, in Fannie and Freddie, it was muddled. And Congress liked it to be muddled, but it obviously caused us some tremendous problems. We need a regulatory and governance structure to ensure prudent risk-taking. It needs to be based on sound insurance principles, and that's very hard to do in the government sector. We need the market discipline, the debt market discipline that wasn't there, and we need much, much stronger capital positions. And then we need systemically prudent supervision. Obviously, the OFAO had written a paper before I arrived, and one of the authors is sitting out here in the audience, about how systemically risky Fannie and Freddie were, and they got a lot of grief about that, but obviously they were right. But I think, what do we do in the mortgage market? And to me, one of the key things is we're going to have to build in some sort of counter-cyclicality to limit the booms and busts in the mortgage market. And how might we do that? Well, first of all, why do we need it? And I think it's pretty obvious that we need to figure out better mechanisms for curbing those animal spirits. It's very hard to take the punch bowl away, as we all know, and none of the regulators were able to do that, and certainly Congress would have kicked them if they had tried to take away the punch bowl. And so we need some better ways to curb asset price bubbles and dampen those credit cycles. If we do that, there's better odds, not totally good odds, but better odds that financial institutions will survive a crisis. And certainly one of the things that we see as the crisis hits, there's a tendency to everybody bail out at the same time, and that just exacerbates the crisis. So it might help prevent the fire sales and the credit crunches that occur as bubbles burst. So what kind of counter-cyclical policies might there be? Certainly looking at the capital requirements and starting potentially varying them with house prices. When house prices get too high, increase the capital requirements. It'd be good if you could increase the reserves, but the accountants don't really let you increase the reserves when things are going well. But that would be another way to do it. Certainly, if there is the catastrophic insurance we were talking about, the government, whoever prices it, could raise it when the market is getting overheated. That might help a little bit. There's a lot of talk about contingent equity, which is a form of debt that springs to equity when there's a problem with the financial institution. Perhaps even the standards on the underlying mortgages could be changed, the loan to values or something, if the market heats up too much. But it's something we need to consider as we're looking at the future of the mortgage market in this country. Everybody has talked about this today, but I might as well lay out what I think are the three basic options for the future of the enterprises in whatever form they may be. Bill Gross of PIMCO, as has already been referred to, has really basically said we need a government guarantee, and the ultimate of that is, which obviously I disagree with, is to merge them with FHA or Ginnie Mae and just let them wind down that way. As has been said earlier, there's tremendous moral hazards in government insurance. I ran the Pension Benefit Guarantee Corporation, and I can tell you we never got that program right. It was created in '74, I think. It's had 10 major fixes by Congress. Congress set the premiums and always set them too low. Originally it was $1 per person. I think it's, well over 50 and not enough now. So it's really hard to run a government insurance program. Also, as part of Social Security, people don't know much about it, but we had the Supplemental Security Income Program, which was the largest cash program for the poor in this country, the disabled and the elderly poor, full of moral hazards. And even Social Security itself has some issues, needless to say. So the idea of trying to create a very strong government insurance program, I think, is very, very difficult. FHA, as you all know, has muddled through this crisis, but it has some big challenges ahead as well. Early days, certainly Secretary Paulson, amongst others, and Chairman Bernanke talked about maybe the best way would be an improved GSE model. The problem is, how do you create that improved GSE model? And you still have that conflict, the tension between the government and the private sector. One talk was a public utility model. The idea is that you would have this very, very smart regulator somehow control the GSEs by regulating prices, size, everything, just like a public utility regulator is. My problem with that was we are dealing with a very cyclical industry, and I just have never quite figured out how the regulator could be so smart. Not to take anything away from FHFA. There's a lot of proposals out there that basically we need a government insured MBS by Fannie and Freddie or some successor to Fannie and Freddie. Some people talk about it as catastrophic, and some people just have it on the MBS itself. But in either case, that is an alternative out there. Another approach, people say, well, let's give them to basically the big mortgage originators and have some sort of cooperative ownership the way the Federal Home Loan Banks are. And again, if you have an improved GSE, you probably need some sort of counter-cyclical capital. We're seeing more, and we heard certainly this morning, more and more talk about some sort of private sector way to get reinvigorated the mortgage market to supply liquidity. Certainly there's the covered bond market in Europe, which is effectively the banks issue bonds that the underlying credit is the mortgages themselves, but then the bank has a guarantee on that as well, so they end up staying on the bank's balance sheets. And in many countries in Europe that has worked, although in some it's not working quite as well, and you'll see prices pretty low in some of those bonds. Again, the government catastrophic insurance as a way to move towards the private sector. And certainly one of the things I think about is, everybody talks about originator skin in the game. The only way we're going to get some real discipline in this market is actually have investors have some skin in the game, that they have some risk, that they force some discipline on whatever succeeds Fannie and Freddie. So let me now just turn to my thoughts, and it's not totally ironed out. I haven't had enough time to really have, and I don't have the kind of staff that I used to have at FHFA to pull a proposal together. But here's the various pieces that I'm thinking about at the moment. Certainly, one of the first steps is to split the GSEs into a new co and an old co. And you really have to do that because the way the preferred stock that's backing it at the moment has been written is it backs the existing mortgage-backed securities and debt. But you want to cut that off by starting a new co. And the new cos could be new Fannie and Freddies. They could be other financial institutions. Here, in fact, let me see. Basically, it's the old co is funded by the Treasury Senior Preferred, and it's really a runoff with then a new co is created, and that new co we can talk about whether it should be a GSE or private sector or how it should be to basically restart the market, if you will. And hopefully it would be funded by the private sector and have a contingent capital structure. Going back, I think one of the things we have to think about is whether we need to put the single family and the multifamily together in this. Actually, throughout this process, the multifamily, Fannie and Freddie, has actually performed admirably. Their default rates, 60, 90-day default rates, are well less than 1% throughout this crisis. And they're actually starting to come down. That's not to say that there's not going to be some problems in the multifamily world, especially as these mortgages mature and there's not a lot of equity behind them. But it's an issue that we might want to look at separately from the single family. But I don't know if we want to split them or is there other ways to do it. Certainly, there should be no direct government support for the newcos, whether it's their debt. And certainly, one would argue that they should have very small portfolios going forward. And then, I think we need a transition, and that's whether it's a 5-year plan, maybe even longer than that. But we need to start to figure out mechanisms to move the marketplace back to the private sector. With the VA, FHA, the Department of Agriculture, and all those other programs supporting affordable housing, and first-term home buyers. Maybe the new codes have some sort of CRE requirement. I don't know, but it's something that has to be very carefully structured, not to have another occurrence like we've had. Certainly, the regulator, the law that was passed to create FHFA less than 40 days before we had to put them in conservatorship, so it wasn't very useful from that standpoint, did strengthen the regulator, but there's probably more that needs to be done there. I would include the state regulated mortgage insurers if they continue to exist under this regulator. There's no reason, especially as they exist just for Fannie and Freddie, that they shouldn't be regulated at the federal level. And certainly these institutions are large enough that they need living wills like the FDIC is doing for the major banks. I think we need to rethink the fully prepayability of a 30-year mortgage. Is there a period that they shouldn't be prepaid, or should there be a penalty, or should you pay more if you want the prepayment option? Again, sounding like a broken record, but I think that we need to create a stronger risk-based and counter-cyclical capital structure to help dampen the extreme cycles we seem to have periodically in the mortgage market. And then probably the more controversial one is that we need, I think, as at least over a period of time, some sort of government support for the MBS. I would hope it'd be a catastrophic support rather than a direct guarantee. So what would this new residential MBS look like? First of all, one of the issues we have that's grew up historically is the Fannie and Freddie MBS are not the same. They have different terms. Fannies trade better than the Freddies. Make a lot of sense just to have standard terms for all MBS payment terms or whatever. And so I think that's sort of a no-brainer. We certainly need clearer rules for mortgage servicers and trustees. I had meetings with the trustees, and they're paid peanuts, and they were not paying much attention at all, to be perfectly honest. Mortgage servicers are underpaid in a market like this and potentially overpaid in a good market. Again, that one of the reasons I'm concerned about the mortgage servicing world is that they have this repurchase obligation, which is fine if the mortgage servicer happens to be the bank that originated, but in some cases it's not. We certainly need greater information transparency on the underlying mortgages. There's been a lot of progress over the last 3 years, and as we buy private label securities now, we do have a lot of information on the underlying mortgages. The American Securities Forum has a project Restart and put together a book this thick of all the requirements for mortgages transparency, and I think that's important. If we're going to restart this market, we need a lot more information for investors. That's the only way we can get some discipline in the market. Certainly we need to have a down payment is 20%. I'm not sure 20% is enough, but let's say 20%, and if there is only a 10%, you need a significant amount of mortgage insurance, and you need it from a well-regulated mortgage insurer. Certainly the originator should have skin in the game for riskier mortgages. And I agree with that we need to start to slowly reduce the conforming loan limit, whether that's to 0 or to back to where it was is all up for debate. But I think we need it's too large at this point. I mean, I have to tell this. I actually refinanced my mortgage and got a Fannie mortgage. I couldn't believe it. 3 3/4 15-year mortgage. How's that? The next thing is how we could structure some sort of catastrophic insurance. But if we do, it has to kick in after everything has hit the fan. Basically, certainly the down payment is gone, the mortgage insurance is gone. If there's originator skin in the game, it's been paid up. And then if there's an investable deductible. So it's really a catastrophic coverage that would a real tail risk, if you will. And again, one could structure this so over time you could raise the prices enough to almost force the private market to restart, which would be one mechanism going forward, if you will, is to think about if there's a way to just slowly ease us out of this security by making the private sector more cheaper, effectively. And then the last thing I want to talk about for a second is, before I open it up to questions, is really how you get skin in the game from the investor again. And there's a variety of ways that have been proposed out there. One is to do what I think Freddie is doing now in their multifamily, where they're guaranteeing an A tranche, which may be 80%, and then there's a B tranche without a guarantee that's sold at a much higher interest rate. At this point, I think they're going 13% in the multifamily world. Again, that pricing of the B tranche does provide some market discipline. Another way to do it would be maybe to borrow a little bit of the FDIC model, where basically the retail investor, if you will, in a mortgage-backed security has the benefit of the government guarantee. But beyond that, if you're over the 250,000 market, there is a hit before the government catastrophic guarantee kicks in. And it may be only 5% or some number like that, but enough that the investors do pay attention to the risk of the mortgage insurer and potentially the underlying mortgages. Okay, I went through a lot, but I'm happy now to open it up for questions. Yep, back there.
Similar kinds of observations made now about improvement in consumer credit with decrease in delinquencies and so forth there. But the problem may be that what you're getting is write-offs in the consumer credit market, and you may be getting fulfilled foreclosures and so forth in the mortgage markets, which are taking these ratios down, and they give the impression, or at least an exaggeration, of the degree to which improvements are actually taking place.
Well, it's hard to argue with that there's certainly foreclosures are reducing that, short sales are reducing that, and even the mortgage modifications are reducing it, and in some case mortgage modifications are relatively temporary, and then we see redefaults. Although I have to say that we are getting better at mortgage modifications, and the redefault rate is coming down, not as much as anybody would like. But yeah, there is certainly some activities that are reducing and having those, especially in the subprime area, come down. There's been so many foreclosures that that may cause some of it. But overall, the view is that we have turned the corner on defaults, but there is always the risk of a double dip, and certainly that's something that all regulators and decision makers have to worry about. Any other questions out there? Be happy to answer. Yep.
Do you have any thoughts on how to restart kind of the secondary market?
I mean, it's very tough, and I don't think you can really get it restarted. There's two pieces of it: the jumbo market, and there was one jumbo security the Redwood Trust issued last year, and we may see a few more jumbos. There's a lot of talk about it, but the pricing is tough there. The problem in the conforming sector is it's impossible to compete with Fannie and Freddie. And so until we figure out what we're going to do with Fannie and Freddie, it's very hard for me to see we're going to see much of a restart in the conforming mortgage. And that's another reason that we should start thinking about the future of Freddie and Fannie and start making some progress here.
I just wanted to quickly ask you, as the regulator, whether you had what your view was about whether it was the increase in the mission goals, the affordable mission goals, or whether it was voluntary risk taking that was the root cause of the increasing riskiness of the portfolios of Freddie and Fannie?
I would say it was both, but probably more on the voluntary side. Our teams would talk to them about the credit risk. One of the first meetings I had with the Freddie board in '06, I mentioned credit risk, and almost got kicked out of the boardroom. They said, "Well, we know how to manage credit risk. It's totally under control." But they did increase their risk appetite. Freddie did it a lot in the private label side. Fannie did it more in the whole loan side. But they created programs to do it. But they also were having not only pressure from their shareholders to do more, they were having a lot of pressure from Congress to do more as well. And they felt if they did more on the affordable housing side, that would protect them from GSE reform in many ways. If they kept Congress happy, they would be less likely to do GSE reform. So it was both. As a regulator, we did a lot of work on that, but unfortunately, as I said earlier, our powers weren't as strong as one would have liked at the time, and moral suasion only works so far.